ערב טוב. אני אפתח בכמה מילים באנגלית לכבודו של האורח. יש פה הרבה חברים. רמקול, אנחנו משתדלים שהוא נעשה את זה ככה אולי. Members of the Berglas family, faculty and students from the Berglas School of Economics, ladies and gentlemen, my name is Yair Serusi, and I'm honored to open this year's lecture in memory of Professor Eitan Berglas. This year, we have the privilege of having with us Professor Jean Tirole from the Toulouse School of Economics in France, a leading scholar in various areas such as industrial organization, regulation, organization theory, and many others. Let me apologize before Professor Tirole for allowing me to say a few words in Hebrew in the memory of Professor Berglas. פרופסור איתן ברגלס ז"ל היה איש אקדמיה משכמו ומעלה, אך גם שילב את העיסוק האקדמי עם כלכלה מעשית. עד מותו הוא מילא את תפקיד יושב ראש מועצת המנהלים של בנק הפועלים, וחותמו ניכר בבנק עד עצם היום הזה. הרשו לי לצטט מדברי ההספד לאיתן שנשא שותפו לדרך, אמירם סיוון ז"ל, שהיה מנכ"ל. הוא אמר כך: איתן ניצב את תפקוד מועצת המנהלים במתכונת שלא רק הבנק, אלא מרבית הארגונים במשק לא ידעו דוגמתה עד אז. ב-1985 שקד להפעיל את הדירקטוריון כמכניזם פעיל ודינמי העוסק ללא הרף בקביעת מדיניות וקיום בקרה. מדהים עד כמה נושא זה נשאר עדיין רלוונטי, אולי רלוונטי מתמיד, גם 25 שנה לאחר מותו של איתן. איתן היה מטאור בלימודיו האקדמיים. הוא סיים את לימודי הכלכלה באוניברסיטה העברית ב-1960, ושלוש שנים קצרות אחר כך הוא כבר החזיק בדוקטורט בכלכלה מאוניברסיטת שיקגו היוקרתית. ב-1966 הוא הצטרף לחוג לכלכלה דאז באוניברסיטת תל אביב, שהוא נמנה על מייסדיו. ב-1971 הוא קיבל את המינוי הנכסף של פרופסור מן המניין. איתן שילב בין העולם האקדמי לבין עולם המעשה. אחרי סיום לימודי הדוקטורט בחר איתן לא לשוב מיד לאקדמיה, אלא בחר לשמש כיועץ הכלכלי לממשלה במשך 3 שנים. ב-1978 הוא יצא לגיחה נוספת מהאקדמיה וכיהן כממונה לתקציבים באוצר במשך 2 אולם גולת הכותרת הייתה כמובן כהונתו כיו"ר הדירקטוריון של בנק הפועלים בין השנים 85 עד 92. במסגרת תפקיד זה הוא התמודד כיושב ראש יחד עם אמירם סיוון המנכ"ל עם התוצאות של משבר ויסות מניות הבנקים, ועדת בייסקי, משפט הבנקאים. בכוחות משותפים, הצמד ברגלס סיוון צלחו הרבה מן המשברים, דוגמת האשראי למגזר החקלאי, והצליחו להצעיד את הבנק קדימה ולהניח את היסודות המודרניים למוסד המפואר שיש לי הכבוד לעמוד בראשו כיום. איתן כיהן כמו כן בשלל תפקידים נוספים, הן באקדמיה והן מחוץ לה. הוא היה ראש החוג לכלכלה, דיקן הפקולטה למדעי החברה, סגן הרקטור, נשיא האגודה הישראלית לכלכלה, חבר במועצות מנהלים של חברות נוספות גדולות, וכיהן בכמה ועדות ציבוריות חשובות, בהם מימון ההשכלה הגבוהה, ועדת בן שחר לרפורמה במיסוי, ועדה לנושא השכר במגזר הציבורי שבראשה עמד. אני אישית לא הספקתי להכיר את איתן, אולם עד היום אני שומע מעמיתים ומחברים עד כמה הוא חסר להם כקולגה, כאדם שניתן להתייעץ איתו כחבר. איתן היה כלכלן מבריק שהתאפיין באינטואיציה חדה וחכמה. הוא הותיר אחריו רשימה מפוארת של עשרות פרסומים אקדמיים בכתבי עת המשובחים ביותר, לרבות ה-American Economic Review, Journal של Political and Economy ואחרים. נכון עשו חברי סגל החוג לכלכלה, כאשר קבעו שהדרך הנכונה ביותר להנצחת זכרו הינה קיום ערב עיון שנתי כמו זה שאנחנו מקיימים כאן הערב. מדי שנה אנו מארחים כאן אנשי אקדמיה מן השורה הראשונה, ובהם ניתן לראות ממשיכי דרך למצוינותו של איתן. אנו בבנק הפועלים רואים זכות גדולה להיות שותפים למפעל יפה זה. I would like now to invite the chairman of the Bergler School of Economics, Professor Tzvi Neiman, for two things. One is to announce those that are going to get some tuition and to present our speaker for tonight. תודה רבה. מיקרופון.
תודה. טוב, אני מתכבד להעניק את פרס בית הספר לכלכלה לעבודת מחקר מצטיינת של תלמיד מאסטר או דוקטורט. הפרס הראשון ניתן לדורון רביד על העבודה שכותרתה שיקולים אקסיומטיים לשימוש באלגוריתם כשכנים הקרובים ביותר לקלסיפיקציה. דורון לא נמצא איתנו הערב, הוא התחיל השנה דוקטורט בפרינסטון והוא לא יגיע. הפרס השני ניתן ליניב בן עמי על עבודה בשם מאיץ פיננסי המבוסס על דיבידנד כאיתות לערך הפירמה. So now I want to introduce our speaker for tonight, Professor Jean Tirole. So it is an honor to present Professor Jean Tirole as the speaker in the Eitan Berglas lecture this year. Professor Tirole is widely regarded as one of the most prominent economists of his generation and of our time. His work spans and includes major contributions in many fields in economics, including industrial organization, regulation, organization theory, game theory, finance, macroeconomics, and now more recently economics and psychology. His list of honors includes presidency of the Econometric Society, presidency of the European Economic Association. He received dozens of prizes, medals, and honorary degrees. His CV, his publication record, includes 7 books and more than 100 papers. His CV is more than 20 pages long, and for people who don't know, it's a lot. Okay, so Professor Tirole, please.
Well, dear member of the Berglas family, ladies and gentlemen, first let me thank Chairman Serusi and Tzvi also for those very, very kind words. And I must say I'm extremely honored to be here today giving this Berglas lecture, named after one of Israel's leading economists. And I think one of the best tributes you actually could do to Eitan Berglas was actually the foundation of this school. First, the foundation of the school itself, which is one of the leading institutions in Europe and the world, and also this magnificent building. And I must say I'm ashamed I'd never been in this building. I'd been before, of course, but this is magnificent, and I think it's a fantastic tribute. The topic of my talk today actually is not going to be at the center of his contributions. You know, he had many contributions to many fields like trade, international finance, public goods, and public economics, and so on. But at least it touches on one of his topics of interest, which is banking, of course, with a connection with Berlin Bank. And so there will be something, and his own view of the link between theory and economics and the practice. Let me say a few words before I start. The first is that it's going to be slightly on the technical side, so don't hesitate to complain if I'm being too technical. But at some point, I will have to develop a model and tell you how it works. So those of you who have a training in economics, that should be fine. At least you should get the intuition. I'm willing to take questions, so don't hesitate to interrupt. If you interrupt too much, I will say so. But I'd rather have questions than no questions because I think it's more fun. At least it's more fun for me. What else do I have to say? Well, that's very important. Much of what I'm going to say is stuff that I've developed with a young economist at Harvard, Emmanuel Farhi. Some of that work also dates back to work I did with Bengt Holmström, but what I'm going to talk about today is about work with Emmanuel. Liquidity has many different meanings, and I'm going to focus on the one which was the most prominent in the recent crisis, which is the difficulty that a number of banks, insurance companies and so on, had to refinance themselves in the market. And that's going to bring me immediately to a very simplified balance sheet of a bank. So I'm sure you are going to laugh, and many people in this room are going to laugh just thinking that's the balance sheet of a bank. But let me just simplify things as much as I can, and just to show you how you can talk about funding and market liquidity. So if you think a very simple-minded bank with an asset liability balance sheet, on the asset side you will have some assets. Some of them are very liquid, partly connected with being very safe, like T-bills. But then you have a bunch of other securities, and you have assets which are illiquid. And you know, the distinction between liquid and illiquid assets is actually very complex and changes over time. And we have seen, you know, for example, CDOs in the recent crisis, you know, assets which are very liquid, and then there are some doubts about their quality, and they become very liquid, and you cannot really sell them except at a very high discount. But there are a bunch of assets, and what you can do when you need some cash, so if you're a bank or an insurance company or whatnot, you can go and sell some of those assets. You can sell those assets, you can securitize them, you can do all kinds of things. You can use them as collateral, like in the case of covered bonds. That's one aspect, and then you tap what's called market liquidity. On the other side of the balance sheet, on the liability side, if you're retail banks, you will have retail deposits, and then you will have short-term wholesale deposits. Then you will have medium-term, long-term debt, maybe hybrid securities, maybe preferred stocks or things like that, and maybe I'm sure you will have equity also. And what you can do if you need cash again is, instead of selling your assets, you can issue new securities against those assets, which amounts to diluting existing claim holders, so your current debt holders or your current shareholders. By issuing new securities, you dilute them. And how much you can do that depends on your corporate governance, which determines the trust that investors have in you, your reputation, your absence of debt overhang, so you can renegotiate some of your debts possibly. And that's what's called funding liquidity. So it operates on the liability side of the balance sheet. But of course, whether you'll be able to face your liquidity needs, so when you need more cash, either to refinance an existing project or to finance a new project, will depend on other factors as well. So for example, risk management. You know, if you get insurance against foreign exchange risk through FX swaps or interest rate risk, then you may be more insulated from that risk. It depends also on your reputation risk. So, for example, are you going to have to come to the rescue of the conduits or the special purpose vehicles that you have created just because your name is on the door, and things like that. Now, so liquidity is going, actually in practice, is going to, and I was talking to Svi earlier about this, liquidity is it's very hard topic to understand and to measure. It's going to, in the theoretical model I'm going to write down, it's going to be very obvious what liquidity is. Now in practice, it's not obvious at all. There's been, in the last few years, 2 or 3 years, there's been a huge amount of work, especially on market liquidity breakdowns. Some also on, I mean, you could basically have the same argument for much of the interbank and funding liquidity breakdowns. And it's going to emphasize various things. And for example, adverse selection, the fact that you don't know the quality of the assets you are buying, or which are used as collateral for repos. Some other route that people have taken is the shortage of financial muscle. So this is just jargon to say that the potential buyers of your assets actually don't have enough cash. They are too levered. They don't meet their capital adequacy requirement, and they cannot buy your assets because they don't have financial muscle. And finally, a third route which has been taken in the literature consists in saying that actually there are no gains from trade between buyer and seller because you have a third party with the supervisor or the taxpayer who is behind. And if you resell your assets, given that you make illiquid asset into liquid asset, then you'll have to recognize the losses. It all depends on whether they were accounted and recognized at market value or not, but often those are assets which do not have markets. And once you recognize the losses, then there will be more capital needed for regulatory reason, and you don't want to do that because maybe you won't be able to raise that capital, or you will have to downsize and sell some other assets. Okay, so that may give rise to market liquidity breakdowns. But then you can ask, why is liquidity a prime? You just go back to the basics. Why is that firms or banks or insurance companies may face a liquidity crisis? There is one possible view is that, if you need more cash, so if your continuation project or whatever you are financing are worth it, then you go back to the capital market and you raise more funds, you dilute existing shareholders possibly or debt holders, and you can do finance as you go. Actually, the old Arrow de Breu theory said, that's perfectly fine. You need more money tomorrow, but then you go back to the capital market, and if it's worth it, people will lend it to you. And then you never have to manage your liquidity ex ante. You never have to plan your liquidity. That's not quite the current view. The current view, which of course takes into account the fact that there is credit rationing, that you cannot borrow as you want, says, well, maybe tomorrow, even if you have a good project or even it's worth rescuing your current assets, you may not be able to find the money in the market. People won't want to lend to you. And that's why actually you have to plan, pay attention that you won't need too much cash. So in a sense, you need to have some reserves, broadly speaking. And what you can do is to do self-hoarding, and then what I told you about the balance sheet actually gives you some insights about what you have to do. You need a relatively low amount of short-term debt so that there's no cash, not too much cash, which is pumped out of your bank or your firm. You must have liquid assets on your balance sheet that you can easily resell at a low discount, and so on. But you can also get some insurance in a contractual form. You can get, by the way, insurance against credit rationing, the fact that you may not be able to raise the money, the cash you need. And the most obvious thing for a firm is, for example, to get a credit line. And if you think about what a credit line is really an insurance contract. So basically the firm goes to the bank and says, give me a credit line. So it's basically an insurance that I will be able to have the cash at some pre-specified interest rate, which may be indexed and so on, but I'll be able to get access to cash up to some limit. Now, the reason we are doing that in advance is that ex post you may not, when things occur and then you're in trouble, the bank may not lend it to you. So you contract with the bank ex ante, it's just like an insurance contract. If you want to insure your house against a fire, you better do it ex ante than ex post when the house has burnt, right? It's the same thing for a credit line. And there are more subtle products, of course, like insurance products, like credit default swaps and all kinds of interest rate swaps and so on, which also are kind of insurance device against illiquidity primes. So then comes another question, and I'm not going to talk very much about that today, but that's a question about aggregate liquidity. Of course, that's something which is important for central bankers and governments, is how much liquidity to bring to the economy. But that suggests in the first place that there is not, or there are states of nature in which there may not be enough liquidity. So at a very abstract theoretical level, there's been a bunch of papers which have looked at when there will be insufficient liquidity. And probably the first was Mike Woodford which basically showed in a simple model that if the corporate sector is on average net lender, then there's a shortage of what's called stores of value, things that you can keep so as to meet shortages. Okay. In this work with Bank Holmström later on, we look at the case where the corporate sector was a net borrower, and we showed basically that illiquidity was associated with macroeconomic shocks. Whatever the case, in all those papers, and there's been zillions of papers in the literature, it's always a case that the lack of liquidity is associated with the imperfect pledgeability of income. So that jargon just to say, when investors give you 1 shekel, you cannot promise, and that delivers 2 shekels, for example, in terms of value, you cannot promise everything to the investors. So the investors cannot grab the entire cake. There are always money or benefits or whatever, or jobs which accrue to the insiders. So the value which is created by investment cannot entirely accrue to the investors. Whereas in our Debreu, the entire value can be pledged to investors. In corporate finance, and that's the whole issue, the whole idea of corporate finance, the investors cannot grab the entire value which is created by the investment. Okay? So there are rents which go to the insiders, the monitors, the managers, the executives of the banks, the traders, the employees, whatever. There are a bunch of monetary and non-monetary benefits that go to the insiders. And that's what gives rise to credit rationing in the first place, and that's what gives rise to the need for insurance against credit rationing, which is called liquidity management. So the imperfect pledgeability of income in those theories, and just mentioning that in passing, gives you both a price demand for liquidity, but also explain why there is a shortage of supply. So it acts both on the demand side and the supply side. Because if very little of what's created is pledgeable, that means there are very few securities in the market, and therefore very few instruments that you can use as stores of value against shortages of income. So actually the supply and the demand sides are driven by exactly the same factor, and the factor being the imperfect pledgeability of value. Okay? So that's the foundation of all that literature. And now, if that's okay with you, I'm going to switch to the topic of the talk after this broad introduction and talk about this work I've been doing with Emmanuel Farhi. Okay? So if there are no questions, I will move on to the maturity mismatch stuff and the systemic bailouts. 2 facts which I want to connect. And you have witnessed those 2 facts, of course. The first is the overall macroeconomic fragility, the fact that many players in the economy engage in maturity mismatch. So basically being very exposed to interest rate risk, short-term interest rate risk. And I will come back to that and explain what I mean by this and give you an example. Second fact, which is pretty obvious, is that there's been huge bailouts. The most visible ones, of course, are the fiscal bailouts. So when you rescue Freddie Mac or AIG or whatever, it's pretty clear what the size of the bailout is. But perhaps one of the main bailouts in terms of size, huge bailout, has been the monetary bailout. The monetary bailout has consisted in reducing the interest rate quite a lot. Actually, the rates are negative in most countries nowadays. The real rates are negative. And that I'm going to explain is really a subsidy to the banking sector, to the insurance, to all the financial intermediaries who are borrowing short term. Okay. Now, there's another question whether this was the right policy or not, and that we can discuss, and we'll discuss it at length. But there's been a huge monetary bailouts in almost everywhere in the world, okay, by having low rates of interest. And I want to argue that those 2 facts are very related, which is that it's a wide-scale maturity mismatch which causes a bailout, and the bailout which causes a wide-scale maturity mismatch. And I'm going to derive some implication for regulation. So let me first document very quickly this maturity mismatch. And by the way, it's not only the banks, it's not only the insurance companies and so on, it's not only the investment banks, but it's also even borrowers, even consumers. So for example, if you borrow for your house and you have an adjustable rate mortgage where the amount you have to reimburse is indexed on the market rate of interest, that means that if the market rate of interest moves from 1% to 5%, your reimbursement increases a lot, right? I don't know in Israel how much, what is a fraction of those. So some countries it can be very big. And that means that consumers in that case are highly exposed to the short-term rate of interest. But even if they don't have ARMs, so if they have fixed reimbursement, there's this issue that they may not be able to reimburse. But they were told, in the US at least, that if the price of housing keeps going up, they will be able to refinance. And if you increase the rate of interest, then the price of housing may not go up anymore, and then lots of households are in trouble. Commercial banks have increased their maturity mismatch, sometimes off balance sheet actually, in a very discreet way. And here is a table which is actually taken from a book by Acharya and Richardson and others at NYU, which look at some of the largest conduit administrators by size. So basically, as you know, what a number of American banks have done, and not only American banks, but is to take some of their assets, like housing assets, which were on their balance sheet, they put it in a conduit, so a special purpose vehicle. Then the special purpose vehicle borrows short-term, almost entirely short-term, sometimes overnight, maybe 1 month. And they pledge liquidity support to the conduit, right? Getting very low capital requirements from that. Now, what happens if interest rates goes up? I mean, if you are a conduit and you borrow at 1%, it's extremely profitable because that means your capital costs nothing. Okay, so as long as you borrow at 1%, it's fabulous. But imagine the rate of interest goes up to 5%, 6%. That means your cost of capital increases by a factor of 5 or 6. And then you are in deep trouble. So you're going to ask your bank, and that was a contractual pledge, to come to the rescue. Actually, a number of those banks have taken the conduits back on their balance sheet. Now you can say it was a minor thing. Not quite. If you look at the right column here, which is the ratio of commercial paper which was issued by the conduit to the bank's equity, you see that it went from 33%, 32% to 300 something percent. It's huge compared to the equity of the banks. Now, exactly what it means is more complicated, but that gives you some order of magnitude that if interest rate goes up, the conduits are in trouble, and therefore the banks which give liquidity support to the conduits are also in trouble. Second factor, and probably you'll have other factors, but investment banks have gained market share. Okay, so just a digression here. Banks have always engaged in maturity transformation. Okay, what banks do is to borrow short to lend long. And just to simplify, it's very rough. Now, the question is to what extent you do that. And investment banks, compared to traditional banks, the retail banks, have gained market share in the last decade, well, until the crisis. And they rely more on repo and commercial paper funding than commercial banks do. So the consequence of that is that you automatically, just by a transfer of market share, you get an economy which engages in more maturity mismatch. And then you can do the same thing with primary dealers, LBOs, and overall, if you look at the fraction of repos and financial commercial paper sales, a fraction of M2, and here you cannot see, but it's about 25%, and it raised to 80%. Huge increase in short-term borrowing by financial institutions prior to the crisis. So that led to intervention that it's an understatement. I'm not British, but it's unprecedented intervention. There's been a nominal interest rate at close to zero. Actually, there's a country where it's even negative, right? One will not believe, but of course there are transaction costs. It's slightly negative, right? I don't remember where it is, but is that Sweden or something? I don't remember. Small, let's put it like this, small in nominal terms. Fiscal bailouts, support to institutions. There were a lot of talk about support to assets. So support to asset prices, that was Paulson and Gertner plans and a bunch of other variants. You could also have support to institutions in those plans, and actually that's what happens with various supports like recapitalization, purchase of commercial papers, underpriced deposit insurance, and other things as well. Now, this is a very visible thing. That's what the voters complain about. But there is also the monetary stuff. Okay, so here is what the theory is about. And I'm going to explain to you, and after that you can fall asleep if you want. But here's the basic story I'm going to tell. I want to argue that the price leverage or capital insurance choices, so how much liquidity you keep on your balance sheet, how much transformation you engage in, depends on the anticipated reaction to the overall maturity mismatch. I mean, in a nutshell, if you expect the central bank to keep the interest rate low, 1%, 2%, your incentive is to borrow short, right? Because, that will be, and furthermore, I mean, you will have a cheap access to capital tomorrow, basically. So that's nice, okay? Now, when the government intervenes in various ways, it may not be able to perfectly target the intervention to the institution it's trying to rescue. And the typical case of that is monetary policy. Monetary policy, when you lower the rate of interest, you lower it for everyone. Not only the bank you are trying to rescue, but the whole economy. So all borrowers in the economy benefit from that. So that means and I'm going to show you mathematically, part of the intervention is like a fixed cost. But the benefit of intervention, which is rescuing the banks or rescuing the insurance companies, actually depends on how many banks or insurance companies are in trouble. That means that if you are taking if you gamble on the interest rate remaining small, I have an incentive to gamble as well. If I'm the only one to gamble, I'm dead, because the central bank is not going to intervene for me. If we all in the same room gamble on the interest rate, then the central bank is dead. It will have to basically lower the rate of interest. Just to give you an analogy, I mean, this is very standard. There's an airport, and later on there can be an extension of this airport. If I'm the only one to build a house next to the airport, then I'm dead, because there will be an extension of the airport. But if we all, build a house next to the airport, well, then the airport won't be able to extend. Politically, it won't be doable. So there are what's called strategic complementarities, which is that if you take into account the policy reaction, then we have an incentive to do exactly the same. Okay? Balance sheet risk choices are strategic complement. So when everybody engages in maturity transformation, authorities have little choice but intervening. And if you refuse, and actually lots of managers have complained about that, if you refuse to adopt a risky balance sheet, that's going to lower your return on equity. And probably as a manager, that means that you may be fired. Okay, so when everybody is playing this game, not playing this game is actually reducing your return, and that means that your shareholders actually may fire you. And this famous citation from Charles Prince, who was the CEO of Citigroup, says, as long as the music is playing, you've got to get up and dance, which means there are strategic complementarities. Okay? Consequences of strategic complementarities, the first I'm not very proud of, but it's possible of multiple equilibria. We all take risk or we all play safe. There may be perverse comparative statics, like it may very easily happen in this kind of framework that if you increase the risk of distress, that may imply more risk-taking, which is completely counterintuitive. Just like if you increase the risk of a flood, you're more likely to locate next to the river or something like that. Which is, but once you understand the policy reaction, that's kind of obvious, because if you think that there is a higher probability of distress and then everybody will have to be rescued, so there are more banks which will be in trouble, then you have to do the same because the central bank will be kind to you. Interestingly, there is endogenous macroeconomic uncertainty. So the way we're going to write the model, we're going to assume that, to start with, by assuming that the risks are perfectly correlated across banks. So it's like a macro shock. But it turns out that if you allow the banks to choose the state of nature in which they are in trouble, they want to perfectly correlate their choices. And that's because of the strategic complementarities. I want to be in trouble when you are in trouble, because that's when the refinancing is going to be easy. Okay? It's exactly the reverse of standard finance theory. Standard finance theory, like CAPM, basically tells you, I want to correlate negatively with you if I can. That's what maximizes the value of my firm, of my bank. That's the standard CAPM logic. Not so here. Here you want to perfectly correlate with the others, because you want to be in trouble exactly when the others are in trouble. Okay? Then I'm going to argue that you have to regulate liquidity. Regulate liquidity in terms of quantity is important, but it's not sufficient, as you might imagine. You also have to regulate the quality. So even if you regulate the amount of liquid assets that can be resold, you also have to regulate the quality of those assets. Lots of those assets were thought to be liquid before, as we saw. So there are also strategic complementarities in choice of asset quality and not only amount. Okay? And then to finish this broad presentation, before I move on to the model, I want to compare policy instruments, because I told you monetary policy is of course not the only way to rescue banks or insurance companies. You can also use fiscal bailout. So what we do with Emmanuel later on is basically look at mechanism design and think about the government optimizing of our instruments and using both monetary policy, so you lower the rate of interest in the economy, and at the same time you may want to build a mechanism for each individual bank. Okay? And both have, of course, some benefits, and it turns out, since I probably won't have time to get into the detail, that it turns out monetary policy is very robust. Even when you can use direct targeting of bailouts, you can bail out Bank A and Bank B and not the rest of the economy, you still want to use monetary policy in general, so lower the rate of interest in case of a crisis. I must say monetary policy is not cheap in this model, and I'm going to show you that. The benefit of monetary policy, meaning that you reduce the rate of interest in case of a crisis, of course, that you rescue the financial sector. But the cost, there are multiple costs. One is that you distort the rate of interest in the economy, so you introduce a wedge between the marginal rate of substitution and the marginal rate of transformation. There is an implicit subsidy from consumers to borrowers, and that's something very concrete. And actually, that's why central banks do it, because you transfer money from consumers, taxpayers, to the banks which are in trouble, so as to get the banks. And actually, when you look at the French banks right now, for example, they are doing extremely well, because the cost of fund is very low. Not in the model that I'm going to show you, but it's in the paper. Another thing that you do when you lower rates of interest is to sow the seeds of the next crisis. And that for two reasons. First, you reduce the overall cost of capital by lowering short-term rates of interest. But also you change the maturity structure. Again, when the current rates of interest are 1%, why do you want to borrow long? Doesn't make sense. You want to borrow short. It's very cheap. Of course, it's very risky too. But you have an incentive to borrow short if the rates of interest are very low. The short-term rates are low. But then you increase the maturity mismatch and you prepare the next crisis. And then there are also other distortions which are not formalized in the paper that are quite familiar. But at least it's market-based. So monetary policy is going to benefit those institutions with refinancing needs, because it's going to benefit those institutions which are going to want to borrow. By contrast with recapitalization or liquidity support, which has a better focus on certain strategic actors, but then the authorities facing asymmetric information, which is what we assume may end up refinancing firms that actually don't need refinancing. So let me stop there. In terms of macroprudential regulation, in this model, like in other models in the literature, it's going to be efficient for the state to provide liquidity in bad times. But the interesting thing is that it's going to end up possibly supplying too much of it in a time-consistent outcome, so when there is no commitment, basically. So the conclusion for that is that you should oversee the overall and not the only individual maturity transformation. So the standard it's very interesting. You have macroeconomics, which is macroeconomics, and then you have prudential regulation, which has always taken a stance which is very microeconomic. I mean, actually, prudential regulation, it's fair to say that it was of no interest to most macroeconomists, right? It's very micro-oriented. I regulate. It's like corporate finance. It's that I regulate the solvency and possibly the liquidity of this bank or this insurance company. Now, what this paper argues, in a sense, is that you should look not only at the liquidity and solvency position of a given bank, but you also should do that, look at the overall situation. Because if there are lots of banks which engage in maturity transformation, then the central bank will have no choice but intervening and lowering the rates of interest. Okay? Now, in terms of the pecking order, if you have to choose who to regulate first, regulate the liquidity of obviously big banks, because for hundreds of reasons their failure is more costly. Those which have a large probability of distress in a crisis and have a large weight in the objective function. By the way, what is an important institution? And there is a difference between the theory and the practice, I would say. If you think about the institutions we regulate, in principle, those are retail banks, insurance companies, pension funds. And the state is a representative of the depositors in those institutions. Now, in practice, what you saw is who was rescued in the recent crisis. Some of those guys, but mainly institutions which were not regulated. Investment banks, no. Insurance companies, actually it was not an insurance company, the AIG was not, I mean, the insurance company was fine. That was the investment bank which was not fine, and so on. So actually you end up rescuing lots of entities which are not regulated. And the reason for that is, of course, cross-exposure. And actually that's part of the game, which is that if you engage in cross-exposure with regulated entities, you yourself, you have access to taxpayer money, right? So the concept of important institution is actually broad, but it depends very much on whether you allow systemic risk, cross-exposure between the regulated sector and the unregulated sector. And this is just a digression. Okay. Okay, so there are three periods. It's a very simple model. I mean, if you want to formalize liquidity, you need at least three periods. You need some intermediate date at which you are going to face some liquidity shock, and you'll have to meet this liquidity shock. So there are banking entrepreneurs and consumers. The consumers have strange preferences. That's because I want to be able to play with the rate of interest. So I'm going to assume that they are risk neutral with respect to their debt to consumption, C2. That's because that way we can just think in terms of expected revenue, just for convenience. I'm going to assume that they are risk neutral with respect to they have linear preferences in their date zero consumption. That's irrelevant, just simplifies. But I'm going to assume some concavity in their date one consumption. That's because I want, the only thing which is important is that I'll be able to play with the rate of interest between date one and date two. And if you had C0 plus C1 plus C2, you will not have been able to play with the rate of interest between date one and date two. That makes some assumptions which basically prevent them from supplying liquidity other than as taxpayers. And there are two storage technologies. So two stores of value that you can have. One long-term store of value where if you spend Q, which is greater than 1, at least equal to 1, you get 1 at date 2. So you spend Q at date 0 per unit, and you get 1 at date 2. There is also a short-term store of value at date 1, where you put 1 and you get 1. Okay? You could also have a store of value between date 0 and 1 if you want, and that doesn't change anything. But two things I want to mention. The first thing is that the natural short-term rate of interest between date 1 and date 2 is what I'm going to, is 1. And what I'm going to call the rate of interest is 1 plus the rate of interest. So you will think the natural rate of interest is 0 because it's a store of value which gives you 1 for 1. And then you possibly have a cost. Actually, you can take Q equals 1 if you want. That's all right with it. The banking entrepreneurs have preferences which are linear, C0 plus C1 plus C2, and they are predicted by limited liability. They cannot have negative consumption. They start with some endowment A, and that will be kind of their equity at date 0. That's how much money they start with at date 0. The rest they will borrow. And let me talk about investment and outcome. So a bank is going to invest I in a liquid asset at date 0. So that's a typical model of liquidity where you invest in an asset that delivers at date 2. And it's going to be constant return to scale, so you invest I and everything will be proportional to I. Now, this is the important thing, is that a typical liquidity model assumes that you may face a shock at date 1. So with probability alpha, you won't face a shock, and you are intact, and you continue, and then that will deliver cash at date 2. Nothing happens at date 1. However, with probability 1s alpha, then you are in distress. So in distress means that you have to bring in 1 for 1 if you want to bring the investment to continuation. So if you want, you can downsize to J less than I, but still you have to bring J to continue at scale J. So what happens is that at date 1, there is like a cost overrun. You need more money if you want to continue. Actually, you can just focus, given the linearity, you can just focus on J equals 0, in which you basically shut down, or J equals I, in which you continue full scale. Actually, we are going to make assumptions under which you want to continue full scale. And what about this shock? Well, I'm going to assume it's a macro shock, so there is perfect correlation between all the banks in the economy. Okay? So they all face a shock at the same time. As I say, if you allow them to choose the state of nature in which they face the shocks, they're going to correlate perfectly in equilibrium. So actually, this is not an assumption. Okay? I want to be in trouble when exactly when you want to be in trouble. Okay? And here's a key difference with an Audebreu model. An Audebreu model assumes that all the value which is created by investment is pledgeable to the investors. So there is never any credit rationing. Basically, all models of corporate finance can be summarized by this, which is that 1 unit of investment, say, creates row 1 unit of value, of which only row 0 is pledgeable to the investors. So basically, row 1 minus row 0 goes to the entrepreneur, to the insiders. So there's a cake, which is row 1, which is created, but not all of it can be pledged to the investors. Only row 0 can be pledged to the investors. okay, in the form of securities.
Will they invest in the bank?
Okay, so the banking entrepreneur, the investors will be consumers. Investors will be consumers. So the consumers can invest in this bank. Well, it's called that a bank, and it could be a firm at this stage. It doesn't make much difference. But so when you invest one, you cannot get more than rho zero back per unit of investment.
The consumers invest in the bank.
That's right. That's right. So you cannot get the full value of your investment. You need rho zero to be less than one. I mean, it varies, there are variations, but just to keep the scale finite. Now, what about the central bank and the authorities? Because they are going to be a key player in this model. The central bank will maximize the weighted average of the welfare of consumers, which we are going to call V. Okay. Okay. Let me just show you back. The consumers have this welfare, and we are going to compute it. And then the banking entrepreneurs have this welfare. And you can think, by the way, the fact that the central bank puts weight on the entrepreneurs doesn't mean they are captured. It could be simply on the banking entrepreneur. It could simply be that they attach a value to the banks doing well because the banks is central to the payment system or is central to the credit system. Doesn't matter. Okay? And it's going to basically maximize an objective function, which is a weighted average of the welfare of consumers and the welfare of banks. Okay? So I've already discussed this meaning. And here is the instrument to start with. And I'm just going to start with monetary policy for the moment, and then talk briefly about bailouts, financial bailouts. So technically, the instruments here will be a reduction in the rate of interest R. The rate of, again, capital R is 1 plus the rate of interest, right? So actually, a monetary policy which is lenient is R less than 1. So R is less than the natural rate of interest in the economy, given the storage technology. So the way you can do it is to tax the date one investment in the storage technology and then rebate the proceeds lump sum to the consumers. Okay? So you tax the investment in the storage technology and then you give lump sum to the consumers. So basically, that's a very crude way of saying you can manipulate rates of interest in the economy, capital R. So without intervention of the government, the natural rate of interest is 1. R less than 1 means that you are intervening and you have lenient monetary policy. Okay? So let me just briefly talk about the bank's behaviors. For those of you who have never seen a liquidity model, here's how it works. So ask yourself, let's have the representative bank say hold X times I at date 0. So X is like a liquidity ratio. So for each unit of investment in a liquid asset, you hold X. So in this long-term store value, right? Then you are going at date 1, what scale can you continue? I mean, what kind of scale can you continue at? Well, what you can do is remember that the investment, the liquid assets, so that's what you have invested in liquid assets, pays off at date 2. So you can pledge XI at date 2. Do you remember the thing with okay, so you invest in the liquid assets, but it gives you 1 at day 2. Okay? So you invest XI, and that's something you can basically resell in order to get cash at date 1. Now the other thing you can do is basically use your funding liquidity. So I come back to the first slide, and you can dilute your existing debt holders and shareholders by issuing more securities. How much can you do? I mean, this is the extreme case. The maximum you can do is rho 0 times J. So remember that rho 0 is a pledgeable income per unit of investment. So for each unit of continuation investment, basically the investors will get rho 0 back. So rho 0J is how much you can pledge to the investors if you dilute fully your current investor. So that the maximum is an upper bound on how much you can raise through funding liquidity.
Those are all two-term security, two-period securities, so there's no danger of a run in period one.
Okay, so no, I mean, if you continue at scale J, here is how much cash you can promise to the investors at date 2. This is your liquid asset that you resell at date 1, but you are going to pay off at date 2. And then how much are people willing to pay for that? Well, you have to divide by the rate of interest between date 1 and date 2. And this equation already tells you a lot. It just tells you the obvious thing that if the interest rate is low, it's easier to get refinancing, right? I mean, it's just a pretentious way of saying, you know, the rate of interest is low, then it's easier to get refinancing, right? And actually, that's why central banks lower the rate of interest in case of a crisis, right? So that's at date 1. So that's you have two constraints. You have the liquidity constraint and you have the solvency constraint. So the solvency constraint is a bit more complicated, but it's kind of obvious. At date 0, you invest I. You start with A only. So you have to borrow at least I minus A, which is the difference. Then imagine that you want to continue when you are in trouble. So from this, if you want to continue full scale, so J is equal to I. So from this equation, you see R minus rho 0 I equals Xi. So you need X equals R minus rho 0 I. This is the liquidity you need in order to be able to withstand the shock. So you need liquid assets, so in case of a shock, you'll be able to withstand the shock. So it's R minus rho 0 I, and you pay that Q, which can be 1 or greater than 1. Okay? And then how much can you promise to the date 0 investors? Okay. Well, if there's a shock at date 1, they are wiped out. They will be diluted and so on. So they are wiped out. So they will get money only if there is no shock, which has probability alpha. And then they will get the pledgeable income, which is rho 0 I. And then you can give them back the liquid assets that you didn't need because you are not facing a shock, which is R minus rho 0 I. So that's the liquidity of your purchase at date 0 that you end up not needing. So here is the value of your securities plus the value of the liquid assets that you, okay? So that gives you, and you know, I apologize for the technical aspect of it, but it gives you a very simple equation, which is basically, it's an investment multiplier. That's a Cook ratio. I mean, for those of you who are interested, it's like a Cook ratio. Basically, you can invest a multiplier of your net worth, okay? How much depends, of course, on the rate of interest. And if you expect the rate of interest to be low tomorrow, then that means it will be easier to refinance. That means you need less liquidity, and therefore you are better off. You can invest more. Okay, so you bring your own equity as a banking entrepreneur. In those models, it's very crude. You bring your own equity as a banking entrepreneur, and then you borrow the rest outside. And it doesn't matter in this model. In more sophisticated models, it does matter, but here it doesn't matter. It's just how much you borrow overall.
How should we think about it? As equity or as a bond?
What consumers are? Well, think of that as being deposits if you want, with the government acting as a deposit insurance through a deposit insurance scheme.
Then if the bank, let's say, doesn't pay, then the bank will have to default.
No, well, yeah, but the government, the deposit insurance scheme will have to intervene, right, and pay to the depositors. So.
This is because of the assumption of perfect.
I mean, here the depositors are risk neutral with respect to date 2 income, so they don't really care. But if they were risk averse, then you will have an insurance scheme, right? Deposit insurance scheme, that's what you will get.
Oh, this is because of the linearity.
That's me, yes. I mean, so we're abstracting, it makes things much simpler, but we're abstracting from a number of interesting issues, yeah. So you get a multiplier, okay? So we make assumption under which the bank wants to withstand the shock always. Let me not get to that. So 5 more minutes just to explain how it works, you know, mathematically. Some very important thing is you have to understand is the distortion you introduce when you lower the rate of interest. So let's introduce this function v hat of r as u of E1 minus S. So if your savings at S is your date 1 utility as a consumer, that's your endowment at date 1 minus the savings, so that's how much you consume at date 1. And S is what you get back. Remember that the storage technology gives you a return 1 for 1. But let's assume the central bank distorts your rate of interest. Okay? Then your marginal rate of substitution will just be equal to the rate of interest, won't be equal to 1. So this function is your indirect utility function, given that the rate of interest you face is not the marginal rate of transformation in the economy. Now, this is a function which is concave, basically, and is maximized at 1, at r equals 1. So the efficient rate of interest is I'm just saying that efficient thing is marginal rate of substitution is equal to marginal rate of transformation. So in our Debreu economy, that's what you will get. Okay. So now, and this is an important, yes?
What is the marginal rate of transformation? It's not production.
No, there is storage technology which gives you 1 at date 2 for 1 at date 1. So the natural rate of interest in the economy is 1. Yeah. So imagine that, let's look at the utility of the consumer. So if they save S, where S is going to be given by this, actually, which is going to be driven by the rate of interest, they will get this consumption at date 1. Then they will get a return which is RS on their savings. But then some of those savings will go to rescue the investment. So actually their savings in the storage technology is S minus I, because I will be used in case of a shock to refinance the banks in some way. Okay? And what do you get back as a lump sum at date 2? Well, the tax. The tax has to be 1 minus R by definition. So the tax is rebated to the consumers. And if you go, and this is a crucial expression, if you go to the final expression when you have a rate of interest R which is different from 1, you get two things. First, you get the deadweight loss I was talking about. This function v hat is maximized when the rate of interest is the natural rate of interest, which is 1. But then you have this expression, which is the exact expression of the subsidy. So if the natural rate of interest is 1 and you have a rate of interest which is R less than 1, then given that it's going to apply to refinancing I by the banking sector, this is the exact amount of the subsidy from consumers to banks. Okay? And that's going to play a big role. Okay? So, two things you can do. One is the thing I'm not interested in, but as a benchmark, is the commitment solution. So, the commitment solution is the central bank says the rate of interest will be 5% no matter what, even if there is a crisis. And I'm going to stick to that. And then there is a time-consistent or perfect equilibrium solution in which the central bank optimizes at date 1. So it can set the rate of interest at date 0 for date 1, commit to maintaining this rate of interest, or it can be time-consistent and optimized at date 1. Okay? And the one I'm interested in is a time-consistent outcome. But just to tell you about economic welfare under commitment, with priority alpha there is no macro shock. Then there is no reason in the model to distort interest rate. And then the consumers get the v hat of 1. With priority 1 minus alpha, there's a macro shock. And then the consumers get this, which is the expression we had here. And the firms will get beta. Rho 1 minus rho 0 is a non-pledgeable income which goes to the banks. And I is their investment scale. Okay? So that gives you a simple expression. I'm not going to get into details, but again, a loose monetary policy creates a deadweight loss, involves an implicit subsidy, but of course boosts investment capacity. Okay? Now, in the time-consistent solution, so there we look at perfect equilibrium, so the central bank optimizes at date 1, and I think it's a much better description of what happens in practice, right? So, in the time-consistent solution, imagine that at date 0, the banks anticipate a rate of interest R star. So that's very crucial. So I'm here in 2006, and say there may be trouble in 2008, 7 or 8. what do I do? Well, I have to think, if I borrow short, at what rate will I be able to refinance? Is that 1%? 7%? That's very crucial. And my profitability and my ability to refinance depends very much on the interest rate. So let's assume I anticipate a rate of interest R star. Then, under some condition, let's assume I want to withstand the shock. So I have to have exactly this amount of liquidity, X star equals R star minus rho 0. So I want to make up the difference between the rate at which I borrow and what I can give back, promise to give back to the investor. Okay, so that's fine. But here is a key equation. The key equation is, now think about the central bank. Central bank might say, well, I don't like having low rates of interest. There's a deadweight loss. And on top of that, I'm subsidizing the banking sector and taxing the consumers. So if I raise my rate of interest above R star, which was the expected rate of interest, here's what's going to happen. Then the banks will be in trouble. They will have to downscale. And here is their continuation scale, okay, which is equal to this. Or you can recompute this. R star is the expected interest rate at date 1 as expected at date 0. R is the realized rate of interest. So if R is equal to R star, so if you have rational expectation, the scale of continuation is full scale, is J equals I. But if R is greater than R star, you have to downsize, because it's harder to refinance. So now the central bank is going to face some dilemma. It doesn't like to lower rates of interest, but if it doesn't lower rates of interest, then the financial system will downsize, which is bad. Okay? So then there is an optimal policy, which is basically going to expose when there is a shock, is going to weight the welfare of consumers, which is this, plus the welfare of the banks, or as perceived by the central bank. And you optimize over R. And you look for a rational expectation equilibrium. A rational expectation equilibrium is an equilibrium in which R is equal to R star. Okay? Yes?
Just to make sure, R star is defined as the interest rate in essence is prior to any policy response on the pocket.
No, so R star is an interest rate between date 1 and date 2, as expected at date 0. So I'm in 2006.
As expected, given that they expected the central bank is going to behave according to the time consistent solution? According
to time consistent solution, yes. So it's really a perfect equilibrium we are looking for. It's a rational expectation, you can say. Okay, so let me give you, I think you have seen enough of the model, but let me give you a little bit of the insight. So the problem is that, again, let me not talk about that. What you're going to get is tragic complementarities. So basically, if you are gambling on the interest rate, which means that you are not holding much liquidity on your balance sheet, then I have an incentive to do the same. Because then it's costly to hold liquidity, so I don't want to do it. If I know that tomorrow the rate of interest will be low, so I'll have an easy time refinancing, then I want to do it. I don't want to hold liquidity, but so there's tragic complementarity. If you do it, I want to do it. And you may end up with the central bank being stuck. Okay? One of the things you can get, of course, I mentioned, is the fact that if given the choice, the banks may want to correlate their shocks. So you get the only strict QBR are maximal correlation in this model. Okay? So this is really the intuition I gave you earlier, is that if you choose the state of nature in which you are in distress, you want to be in distress when refinancing is easy, so when other people are in distress. Yes.
Do you get multiple equilibria?
Yes.
In the case with just the alpha 1 minus alpha?
Yeah, you often get multiple equilibria. Again, it's the same thing as the airport, you know. We all move next to the airport, and nobody moves next to the airport, right? That's a standard thing. And same thing, you know, if I see the other banks taking a lot of risk, so that, you know, the macro shock, for example, might be the bubble, the housing bubble exploding. There's a macro shock. We all bet on that. All the important banks and whatever bet on that. And then the central bank is stuck.
Can you see it, the optimal R star as a function of
Yes.
liquidity function?
Yes.
That's what I'm missing.
Yeah, well, I went to...
Okay.
And also the way it's written, it's not a smooth function. But so what we do is comparative statics on the equilibrium set. But basically, you know, if I expect a low R star, I want to hold very little liquidity, and then the central bank will have to have a low R. So that's self-fulfilling.
They all have identical expectations.
They all have identical expectations. That's also, I mean, making lots of strong assumptions here, but you know, it's not a rational expectation kind of thing. Okay, comparative statics. You get exactly the reverse sometimes of what you get in any corporate finance textbook or whatever. You may have the situation where, say, for example, a larger fraction of banks are in distress in the bad state of nature. Instead of being one, it's just a fraction gamma. You increase gamma, and then you actually may want to take on more risk, which is kind of surprising. So if you're more exposed to risk, you may actually want to increase your exposure to risk. Yeah, well, just tell me. I mean, I don't want to speak too long either, and so let me just tell you a few more results that we obtain in this approach. Okay, sorry, I went way too fast on that. So imagine that when there is a macro shock, instead of having 100% of the banks in trouble, you get a fraction gamma in trouble. Okay? Random fraction. I mean, it's a randomly distributed across the banks. If gamma increases, that means that you're more likely to be in trouble. But it may be the case actually you have more incentive to take risk because you know that there are more banks who are going to be in trouble. And therefore the rate of interest would be very low. X is the liquidity ratio, how much you invest in liquid assets. Sorry. Is that? Okay, so macroprudential regulation is small. You want to look at, and this model is way too simple. So if the central bank, if it doesn't want to have to intervene, has to behave as a supervisor. Either it has to commit to a rate of interest, but that's hard. But it can also try to prevent the crisis ex ante as a supervisor. So it can ask for liquidity. And in this model, the liquidity, the X, should be 1 minus rho 0. So per unit, you have to put 1 minus rho 0 in liquid assets. In this model, that's very, very simple. In practice, of course, it's much harder. I mean, when I show you even a simplified balance sheet, it's actually pretty complicated. And actually, that's one of the things that supervisors are thinking about now, how to improve our liquidity ratios and stress tests and so on. And that's something we are not very good at, honestly. Especially we academic economists suddenly are table. But even the practitioners, it's a very difficult thing. Right, that's right. Because then, of course, the supervisor may not care about the welfare of the central bank. So that's the possibility. By the way, something which is interesting is prices versus quantity. Imagine you're in a situation where your financial sector may not hold enough liquidity. So one thing is you may say, we are going to force them to hold liquidity. The other thing is to be more hands-off and say, well, let's subsidize liquidity. So that's like reducing Q in this model. You subsidize the holding of liquidity. And actually you make things worse in this model. You definitely don't want to use a price instrument because if you subsidize liquidity, they will take advantage of that to increase their investment and make it even harder to not to intervene. So actually, you want to use a quantity instrument and certainly not a price instrument in this model. Okay, and let me conclude with a few notes on on monetary and fiscal bailouts. So what we do there, and I'm going to go very quickly, forget about the mathematics, but of course I'm going to erase this because when you say to someone, forget about this, you're quite sure that everybody will focus on it. So psychologists have this thing with, don't think about the white bear. And then, of course, everybody thinks about the white bear all the time. But I can erase, that's good. So there's different kind of inefficiency with fiscal bailouts. So fiscal bailouts is, you have a mechanism in which you can say, well, you can ask money from the government. In exchange, we take some of the shares and we'll force you to downsize, possibly. So it's a kind of bailout mechanism in which you go to the bank and you offer a menu. You offer a menu in this model because you don't know whether who is facing a shock or not. And that's why, again, we are going to need only a fraction between 0 and 1 of firms facing a liquidity need when there is a macro shock. And you won't know who is facing a liquidity shock or not. So you may end up refinancing a bank which actually doesn't need the money. You need a menu that's mechanism designed so as it has to be incentive compatible. So basically, the government, the instrument for the government, and that's the only thing you can do under some assumption, is to set the rate of interest, that's monetary policy. Then you say, well, I can give you J, I'm going to refinance you at level J, and then I take some of your shares. And possibly you can even have in this model, and that occurs in a small region, you can also pay the banks for saying they don't need money. So you go to them, it's just those of you who are used to mechanism design and incentive compatibility will understand. You may even go to the bank and say, tell me you don't need money, I will give you money. Just to make sure that you give money only to the ones which need. I mean, you refinance only the ones that need. And that may help with incentive compatibility. That may look strange to you, but that's part of the optimal mechanism in some region. Okay, so let me not get into that. And basically, one of the main conclusions is try to look at when the rate of interest is less than 1, and it's basically always, unless you don't have any adverse selection, in which case you want to have just fiscal bailouts. But in general, and you have a region with multiple equilibria, but in general you get a rate of interest, and even you have a region with pure monetary bailouts, where you don't even use fiscal bailouts. So that's one of the conclusions of the paper. Okay, let me not talk about this, because I think I should be concluding here. So in terms of the conclusions, what drives the thing is really strategic complementarities. Again, I want to do it if you do it. I want to have a maturity mismatch if you also have a maturity mismatch, because there is a policy reaction of the central bank, and more generally the government, if you allow for fiscal bailouts. There is time inconsistency. The central bank might want to say, I'm going to be tough and the rates of interest are going to be high, but if it's not credible, then you have to use some kind of liquidity regulation. Endogenous correlation will be important. We should not believe that in CAPM necessarily. There may be lots of institutions failing at the same time. And then we get a bunch of implications, including mandatory capital insurance. So let me stop here. I'll be glad to answer to some question. Again, I want to thank you very, very much for inviting me to give this lecture. It's a big honor to be giving this lecture today.
I think that first of all, if there are any questions to John.
So I work at the Fed, and we're obviously thinking about these things. So let me ask you a question about the timing consistency part. In reality, we're never in period 0, 1, or 2. We're in all of them at the same time. These actions are going on. And it seems in the 3-period structure, monetary policy has this big timing consistency problem, but regulatory policy seems like it wouldn't in this structure. But is there any meaningful sense in which we can get around the timing consistency problem by more, better informed macroprudential regulation?
Well, I think the macroprudential regulation is actually a response to timing consistency. I mean, that's, I think, what you said. And if the central bank were able to say, I'm going to remain tough in those state of nature, then, you know, you'll not have to regulate liquidity that much. You'll have to regulate it some. I mean, there are some other work on that, but not to this extent. Now, it's pretty hard, I think, for a central bank to say exactly when it's going to intervene, because it's also the case that the central bank has a useful role to play in bringing liquidity in bad times. I mean, that's actually the stuff I did with Bank Armstrong. So actually, we want the central bank to bring liquidity in bad times, but we don't want to bring too much. And, you know, how do you calibrate that? And it's actually very hard to calibrate. So, you know, in the end, what, you know, Ben Bernanke and Jean-Claude Trichet, and Stan here, I'm sure, you know, they all did was to lower the rate of interest because that was the only way to go. Ex-post, that's what you should be doing ex-post. It has some cost ex ante, but you know, unless you're able to commit and build a good reputation, it's hard to build a good reputation either, because those crises don't occur every year. In life, as a central banker, you don't face 10 of those crises, fortunately. So that's why I think, and that's my current thinking. I don't know if it's correct, but you know, I will be in favor of going to liquidity regulation and looking at the overall, also not only the individual position, but also the overall position of all the key players, and then worrying if there are lots of key players which are illiquid.
I have a couple of questions. Number one, what do you think of the following idea for possibly alleviating, maybe not overcoming, but alleviating the time consistency problem? And that is that the central bank, sometimes the central bank decreases the interest rate and sometimes it doesn't decrease the interest rate. So in other words, sometimes there is a bailout and sometimes there is no bailout. And in such a case, it's going to be much more difficult for the banks to coordinate expectations. So in other words, for example, in the airport example, you know, you are an individual, you're never sure if you move near the airport, you know, counting on everybody being there and being accommodated.
And I think two costs with this policy. I mean, it's interesting thought, but there are two costs. The first is that sometimes actually you will be doing the wrong thing, and that will be very costly. But also think in terms of incentives. I mean, imagine that Ben Bernanke had kept interest rates at 5%, which actually they were in 2006, 2007, they were still over 5%, right? You think what will have happened last month? I can tell you what will have happened. I mean, poor Ben will have been out very quickly. And the US will have been in big trouble. Would have been in big trouble. And do you want to have this kind of?
Well, I was just thinking theoretically, no, because you know you're thinking about the interest rate, but I'm thinking about fiscal bailout.
Oh, fiscal bailout.
We have seen that they actually did that once with Lehman Brothers.
Yeah.
I mean, you know, they did bail out.
Yes. No, they tried to engage in constructive ambiguity, but somehow. Lots of people say Lehman Brothers was a mistake, and clearly exposed it was a mistake, but you also see the ex-ante point of view. The ex-ante point of view, which is that investors were thinking that Lehman Brothers would be rescued. They kept lending to Lehman Brothers. I mean, it was a shock to the financial committee that Lehman Brothers was not rescued. I mean,
yeah, but this is because they believe.
It was not even regulated. I mean, just having its cake and eating it too. I mean, it's just, you have an institution which is not even regulated, and then has direct access to taxpayer money, or thought, everybody thought it would have access to taxpayer money. I think if we could do it ex ante, that would be much better. The cost exposed is too high. Yeah, of course, we can let Amaranth go bust, or we can let Bearings go bust. But even LTCM, we worry about it. You know, LTCM is not that big. We worry about it already. So it's very disruptive. Now, there are other things you can do so as to limit the disruption. And, you know, I think there's a whole range of other things we have to do, you know, including the use of central clearing counterparties and all kinds of other things and standardized products, at least for the banks, because the banks and the insurance companies. Because right now the problem is that the non-banks, which are not regulated, have a huge subsidy from the taxpayer. They have access to taxpayer money. And that, I think, is something which is very wrong.
The second question is related to that. That is, your model implies that the central bank should actually use two tools, two classes of tools. The interest rate on one hand, and some direct regulatory intervention. Do you have a view of that about whether regulation should be vested in the central bank?
Well, that's an old debate, yeah.
Should it be outside the central bank?
That's an old debate about conflicts between different goals. Maybe we can discuss this later on because it's going to take us far away from this, but it's obviously a very important thing.
Jean, I wanted to ask you, what about the case in which monetary policy is not available, say like in the case of Greece, that you belong to a currency area and you don't have an independent monetary policy?
Well, that means that, and actually there's also the issue of what you eat when you eat the zero rate of interest, which is also a case in which you don't have monetary policy anymore.
So in some sense, this model, I mean, taken from another point of view, is another case for the flexible exchange rate regime, where you have the degree of freedom of monetary policy.
Yeah, which you no longer have for Greece. But again, there I would have advocated ex-ante regulation. And Greece cheated on the various accounts, and that's there's nobody from Greece. I should check first. But well, I mean, being a Frenchman, I cannot be very proud either. So, but yeah, I mean, we all know we're cheating with the accounts, and you know, that's something. It's just like, you know, what you apply to banks, you can also apply to countries, and yeah, that's.
On another topic, what about inflation? I mean, you lower the interest rate and you do all this.
This is technically it's a real model. I mean, then there's the issue about nominal interest rates and inflation, which are not considered, but you know, presumably you could add them to the model as an extra cost with inflation and relative price distortion, just like in neo-Keynesian models. I took the simplest route. Thank you. Well, thank you very much.
Please sit. כמה הערות לסיום. Well, I think that, first of all, thank you very, very much. I think that you help us all to understand that banking is more complex than you realized when you came in, I'm sure. And B, that it's better not to be in a liquidity crisis. We in Israel are very liquid these days, and I think that we feel it all over the markets. We came out of this crisis, I would say, quite stable, and relatively took it quite easy compared to other parts of the world, which is very interesting to see how the world could be divided to different regions, although we are so much linked to each other in the monetary policies, which is, I think, very interesting when we look forward. So I want again to thank you all for being here with us. Erev Tov.